We all have that broke friend or that broke relative that we never want to loan them any money because we know if we loan them money that we're never going to get it back. Because who in their right mind would loan anybody money when you know that they don't have any cash on hand? They don't have a rainy day fund. They don't have an emergency fund. They have zero reserves. Because if you're to loan somebody money knowing this, that would either make you crazy or stupid. And you're not crazy and you're not stupid, right?
Right.
We're getting ready to find out. What's going on, y'all? Welcome back to the channel, Wealth Hacker Labs. I'm your grateful host, Jeff Rose. And what we're talking about today is why you don't want to keep money in the bank, which maybe goes without saying, but it is worth saying again. For those that are new here, awesome. Glad that you're here. Be sure to subscribe, hit that notification bell. For those that are returning, what is going on, y'all? Welcome back to the channel. For those that are new here, or maybe that you're not new here and you just didn't know this, I thought I need to share a little bit about some background of why I'm talking about this.
Okay, I'm listening.
First things first, a little bit of my background. So I was a financial planner for 16 years, was the CEO of my own wealth management firm. While I was doing that, I also had a relationship with a credit union. So I was able to work with them, work with their clientele, got to know the CEO, got to learn just their business operation. And I mean, it's pretty much what I imagined going there. Their role, whether it be a credit union, whether it be a big bank or a small bank, their goal is to get you on as a customer. So that's where they want to open up that free checking. They want to open up that free savings. They want you to become a customer so that they can then start marketing other products and services to you. And this is really no different than all the investment firms out there. They want to get you in as their customer, their client, open up that Roth IRA, start investing. And once they got you, that's where they want to start marketing other products and services to you. I mean, this is really no different than traditional business, right? They want to get you in the door. Once they get you in the door, how can they figure out different ways that they can make money off you? This is how you monetize, every single relationship. But don't fall into the same trap that many of us fall into, that you need to open up a savings account. You need to have a bank account, as if that is the only way to invest, or that is the only way to save. But when you finally understand how banking works or how banks make money, that's when you start to get enlightened, and you don't want to fall into that trap like many of us do. Now, for me, with my upbringing, my parents really didn't invest. They saved, they had money at the bank. So the fact that they didn't invest, and they told me time and time again,
"Hey, Jeff, you need to save money."
And since they weren't huge investors, that meant saving money was not at an investment firm or in a mutual fund or in stocks. That meant saving money was at the bank. That's all that I knew. And I'm guessing you can relate to that in some way, shape, or fashion, because that is traditional banking. You open up a savings account, you got your checking account, you put the money at the bank, they pay you interest and let them do the rest. But what you don't know is, how is the bank making money? Obviously, if they're paying you a certain interest rate, they have to go make a profit or a spread on that return. Before we get into that, let's first talk about this broke friend or this broke relative. That you just wouldn't feel right loaning somebody money that didn't have any way to repay you. I mean, in that case, you're not really loaning them money, you're giving them a gift, or at least that's what I've been told. You never loan money to friends or family, you just give it to them because you're probably not going to get it paid back.
Where's my money?
Most people are familiar with FDIC insurance. This is the insurance that banks have, and this is to protect you in the event that if the bank were to go bankrupt or something catastrophic happens, you have some sort of insurance that's going to protect you on your deposits. But what a lot of people don't know is that there is a certain percentage that banks typically are required to have on reserve. This is referred to as fractional reserve banking. And how this works is that for all the deposits that banks have on hand, they are supposed to keep a certain percentage of those deposits in their reserves. So say, for example, if the bank has $100 million in deposit, 10% has been that rate that they need to have cash on hand. And this is no different than having an emergency fund. Typically, you'll hear financial experts recommend having 3 to 6 months, maybe 9 months, maybe even 12 months of cash on hand in the event that something happens. Like, that is your cash reserve. That is there to help you for the what if. Based on the bank size is the requirement that they were supposed to have on cash reserve. So if it was a bank that was between 16 and 124 million, it was 3% that they were required by the Fed to have on reserve. Anything bigger than 124 million was 10%, which you want that, right? You want that bank to have some sort of reserve because, once again, remember that they are investing your money and you have no idea how that money is being invested. And this is all the information that you don't get whenever you open up your free checking account, whenever you open up a CD. I mean, the bank is not going to offer any of this information, but this is information that you need to know. But is this really a big deal? Well, having some sort of cash reserve, I think that we feel good about that. But what happened is, and you can check it, I'll have a link to this article in the description, but back during the pandemic, the Fed came out, so the board met, and they basically took away this Federal Reserve requirement. And you could see it right here, where now there is no reserves that are required by any bank. So the bank they're not required to have any cash on hand. So when you really think about that you are loaning money to a bank, to a financial institution, that they have no requirement to have anything in reserves, anything there in case something happens. And this is a big deal. Now, maybe nothing will ever happen, but what could happen, it has happened in the past, going back to the Great Depression era, is that when people started freaking out because the markets are all over the place. And when I mean all over the place, that's mostly all over the place going down. People wanted to get cash. They want to have that safety, that security. So they're making a run to their bank, pulling out everything that they had. And I get it, right? Like, you go to your phone right now and wherever, or log in online to your bank account, you can see how much cash you have on hand. But that is just digital. Like, that is digital currency. Maybe not even as good as digital currency like a Bitcoin or some other cryptocurrency, but that's just a number that is there. But if you and every single person that is a banking customer were to attempt to make that withdrawal, at some point in time, the bank is not able to produce all of those requests.
We cannot do that.
Now, maybe for you, this isn't a big deal. Maybe you don't stress out about a bank going under. You don't stress out about going to your bank or logging into your bank online and trying to get all your money out, only to get some sort of error message that says, sorry, cannot complete your transaction. But here's the thing that you need to know. And this is, I think, really just driving this point home of why you don't want to keep your money at the bank. So the bank's job is to make money, right? Make money off you by that spread. Now, I'm going to show you this, and I think you already know this, but I mean, check this out, right? So this is one of my savings account, and this is at a decently large bank. It's a US bank. In this particular savings account, I have just over $300,000, almost $330,000 in this savings account. And what you can see here on the screen, that's how much interest that I got paid on this account. So for the entire month of October, I got paid $2.88. $2.88.
I want my $2!
Oh my God.
And my bank is the only one. This is Bank of America. So you can go to their website, type in your zip code, and it shows you like how much they are paying on their savings account. If you have less than 2,500, you get 0.01%. Anything more than that, guess what? 0.01%. But okay, maybe you're a gold tier member or a platinum honors member where you can get up to, look out, 0.04%. Call the presses. I mean, it is time to get crazy because now you're making 4 times as much at 0.04%. So you're loaning your money to a financial institution that's paying you next to nothing. And this institution is not required to have any cash reserves at all. And they are taking that money and investing it and making a whole lot more. And what's even scarier is, how are they investing that money? You know, we can go back to the 2008 financial crisis where banks were taking on way too much risk, investing into collateralized mortgages. And we know how that ended. So why on earth would you want to loan your money to somebody that is taking on more risk than you are comfortable with? And let me also remind you that you are completely oblivious to. Like, you don't even know how the bank is investing your money. Like, you have no clue. They could be going to Vegas, putting it all on black, and just having a crazy time. Okay, let me say this. Obviously, I just showed you one of my bank accounts, paying me also next to nothing. So I am not here saying that you shouldn't have some money in the bank. You need to have that emergency fund money, right? That is your rainy day fund. That is in case something happens, that you have money to fall back on. You don't want to put that money at risk like that. You just need to know that that is there. That is security. That's for you. That's for your spouse. That's for your family. In the event that something happens, life throws you a curveball. But anything more than that, anything more above that 3 to 6 months, 9 months, whatever that is for you, why on earth would you have that at the bank? This is when you need to become more like the bank. This is when you need to become the bank and invest like the bank does. Now, I'm going to have another video that talks about some different banking options where you can make a lot more than the 0.01% like I shared before. But before we even get to that, it's all about learning how to invest. It is understanding the basics of investing. And if you've not started investing, I don't know why. What are you waiting for? There are so many different investment options out there, so many investment vehicles. And maybe that's what it is. Maybe it's too confusing. I always challenge people to pick one investment platform, whether that be a Webull or a Robinhood or a Betterment or an M1 Finance. Maybe it's Coinbase. Maybe you want to start with Fundrise, where you want to start investing into real estate. Something like that. The whole key there is that you start with a small amount of money and you learn through experience. Now, some people might think I'm crazy for even suggesting that, but I'm not talking about taking your entire life savings. I'm not talking about taking your emergency fund and gambling with it. I'm talking about taking less than $500, opening an investment account somewhere, maybe one, maybe two, and just going through that process of opening the account so that you start understanding how the process works. You have to do some research on picking the ETFs or the mutual funds or the individual stocks or the pies or the portfolios, like whatever those are with these different investment platforms. And as you go through that process, you're going to learn so much more than you are right now, even watching this video or binging out on, I don't care whose YouTube channel. You learn more by doing. So I'm not saying don't watch other YouTube channels, don't read books, don't listen to podcasts. You can definitely get a lot of information there, but you get 10x, 100x more by actually going through the process, picking that first investment, making that first purchase. Like, that is something I am super passionate about, and that will begin the process of becoming your own bank. All right, y'all, if you need some more resources on how to invest, different banking options, be sure to check the description. I got a ton of links for different resources and other investment platforms that you can check out. As always, I appreciate you. I appreciate your time. Be sure to subscribe, hit that notification bell. And this is Jeff Rose reminding you that it's your money, it's your life, and only you can make it awesome. Until next time, peace.